Asia is one of the fastest growing regions in the world, and its economic growth has a direct impact on global forex markets. Understanding how Asian economies influence currency movements can give traders an edge. Let's break it down. First, GDP growth drives currency. Strength economic growth, measured by GDP, reflects the health of an economy. Strong GDP growth in countries like China, India, or Singapore attracts foreign investment. Foreign capital inflows increase demand for local currency, strengthening it. Conversely, slow growth or contraction can weaken the currency as investors look elsewhere. Traders watch Asian GDP releases to anticipate long-term trends in major currency pairs. Second, trade surpluses and deficits matter. Many Asian economies are export-driven. A country with a trade surplus exports more than it imports. This creates demand for its currency, which can appreciate against others. A trade deficit can have the opposite effect, putting pressure on the currency. For example, China's trade data often influences USD-CNY and other regional pairs. Third, interest rates and inflation in Asia. Central banks in Asia adjust interest rates to manage growth and inflation. Higher rates attract foreign investment, currency strengthens. Lower rates stimulate the economy but can weaken the currency. Traders closely monitor Bank of Japan, Reserve Bank of India, and People's Bank of China for hints on future monetary policy. Fourth, regional influence on major currency pairs. Economic growth in Asia affects global forex pairs, not just local currencies. USD JPY, AUD USD, and USD CNH are highly sensitive to Asian economic data. Strong Asian growth often boosts commodity-linked currencies like the Australian dollar or Canadian dollar due to increased demand for resources. Even small shifts in GDP, trade, or inflation can trigger volatility in these pairs. Fifth, investor sentiment and risk appetite. When Asia's economy is strong, global investors are more willing to take risks. Risk-on currencies rise. AUD, NZD, KRW. Weak growth leads to risk aversion. Safe haven currencies like USD, JPY, or CHF benefit. This connection between economic health and market psychology is key for forex traders. In summary, economic growth in Asia shapes forex markets through GDP-driven currency strength, trade surpluses or deficits, interest rate and inflation policies, influence on major currency pairs, investor sentiment and risk appetite. By understanding these factors, traders can anticipate market trends, manage risk, and make informed decisions. In Forex, staying informed about Asia's economic growth isn't optional. It's essential for profitable trading.